If there is one thing that I can be certain of, that'll be that market will be red next week. I mean, really red. It looks like the theme of the market is wear red, day in, day out, just put on red. So CPI data came out yesterday and I was totally surprised to see analysts nail the data. I mean, CPI looked great, well, on the surface because analysts were able to predict exactly what it's going to look like. But what's going on inside is really dangerous. So I'll share some stats from the CPI data and a warning for all investors because next few weeks will be highly volatile and will define how we are going to end 2022. So let's start by talking about CPI data. So here are 5 takeaways. The CPI index was up 7.9% from the prior year, the most since 1982. Jobless claims rose more than expected but still show a tight labor market. I mean, there are jobs all over the place. Rent, food, and energy were on multi-year high, and more than 40% of the monthly core increase was for shelter and food, which is at its peak since the economy first started to reopen back in April of 2020. And overall, real wages suffered one of the most biggest decline in data that goes back to 2007. So these high prices are really affecting how folks are spending their money. Now, with all these inflation numbers, which actually surprised many, including myself, as I was estimating that we will see higher number, some analysts are calling this a calm before the storm. Now, eyes will be set for the March reading, which is going to be more aggressive because the momentum towards the end of February for food and commodity, it surged because of the Russia-Ukraine invasion and also with the supply chain bottlenecks resurfacing. Now, one of the worst things I saw in the latest CPI data was that the headline print are signs that some goods inflation is spilling over the core services inflation, and energy costs are being passed through to core inflation. This will lead to a more stickier inflation that will take time to settle, and time is what we don't have. That being said, let me show you 2 charts which shows how divided the market is and why this reading was not a good news. So let me share the screen and show you. On top is what you see used car prices. And now we have seen, and the reason why I'm showing only these 2 charts from the whole CPI data, there's a reason and I'll explain in just 1 second. So pay attention to what's going on to the used car prices. So if you can see from almost January to now March, we have actually leveled off in the used car prices. That means we have seen a little decline in the used car prices right here, which is a good news. That means the used car prices are cooling off. But not so good news is look what's going on with the gas prices. So now we were estimating that as we come out after February, we are going to see a decline in inflation. But then the gas prices or the energy prices, it's what's causing the inflation to skyrocket and be in a multi-year high for months to come. So this, as you can see, this was 2022 in the beginning, and you can see right here, we have seen a sharp increase in the energy prices right here, and we are at all-time high right now because of the Russia-Ukraine situation. So even though these 2 charts are contradicting itself, one is saying that, you know what, the prices are leveling off. That means used car and truck prices are coming down. At the other hand, we are seeing that the energy prices are skyrocketing because of Russia-Ukraine. This has caused a very, I would say, imbalance in terms of where the inflation is headed. These prices are now trickling to the core inflation. That means that we are going to see this elevated levels of inflation for a very long time, which is going to end at the end of this year. And I'm afraid to say this, but I think we are going to see these market conditions prolong till the end of 2022 or maybe the beginning of 2023. This is not a good news because we have seen the value of our favorite stock have lost so much value over the last few weeks and few months that I feel from here on, if we see another downturn in the market, that's going to be devastating for some of these stocks. Especially with now China banning some of the IT or some of the tech stocks being listed in Hong Kong, that's going to put even more pressure on some of the stocks that we are in. For example, Baidu, for example, Neo, for example, all these companies where we thought that they're going to be the next big thing. Not anymore. And I know some of you have gotten out of the Chinese stock, which was a very smart thing to do back in October and November when we had that initial issue with the Chinese stock. So this is what's really bothering me in terms of the new latest CPI data, because I feel that the March reading is going to be really painful and we are going to get another shock. Now, who knows what the war is going to do? Even though the war or the Russia-Ukraine situation may cool down, because see, the thing is, market is always looking for what's next. Market has already priced in what Russia and Ukraine is doing. Market has already priced in a 25 basis point increase. But what market has not priced in is what are we going to look at in the new CPI data, where the inflation is heading. I'm estimating we are going to see around 8.5% reading as we get into the April for the March number, because again, those high energy prices, those high commodity prices didn't take effect till later part of February. So they were not a true reflection in the March report. They will be the true reflection in the April report. So what I'm seeing here, it's not, I would say, settling well with me personally, because I feel we are going to see some bad conditions in the market in the coming months. So buckle up and be prepared. Now, let me share with you a watch list, which is simple and yet tell the tale of the whole world. So take a look over here. So take a look at this watch list. Now, this is a watch list where I have actually entered some of the stocks, which is very, very favorite to me, and I personally are invested in them. And also some of the stocks that basically tell the tale of the market. So if you pay attention over here, take a look over here. First is Berkshire Hathaway, and look at year-to-date price change. 8.5 or 8.25% increase since year to date. Then comes Tesla, about 20% drop. Then comes Apple, about 10.61% drop. Then comes Google, Amazon, Microsoft, Facebook, and start seeing from Facebook. We have 41%, almost 42% drop in Facebook. Then we have Nvidia, about 22% drop. AMD, 26% drop. And then we get into the stock which is all on member growth, also on financials. Then we have PayPal, 47% drop. Then we have Affirm, 63% drop. Then we have SoFi, 40.48% drop. Lending Club, almost 37% drop. And then ARK-F, around 37% drop. The reason why I'm showing you this watch list and I'm reading these names to you is to pay attention to this. The stocks or the commodity or the equities that you are seeing over here, like Tesla, Apple, Google, Amazon, they are large cap and large fund companies. Their drop is only 8 to 15% in that range. All the companies that you see all the way from Microsoft is actually not bad except Tesla, and Tesla has always been very volatile. But if you pay attention to the last 1 year, Tesla is still almost up 20%. But all these other companies, they are not. All the other companies all the way down, starting from F&G, starting from Affirm all the way down here, are the growth companies, are the companies which has seen the most pain in the market, and they will continue to get hammered as we get into the later part of the year because of inflation. See, all these companies, Google, Amazon, Microsoft, they have many sources of income. They have their cloud services, they have their advertising business, they have their hardware business. They are talking, they are actually covering a lot of different sectors. But when you get into these growth companies, they only have one way of making money. For example, PayPal, members. SoFi, members. Yes, they have Galileo. Yes, they have Technisys, but their majority of their revenue comes from one source. And that is where we see all the issues where people are being scared of putting any new money into these stocks. And we will continue to see this because as market reopens in a way, as confidence comes back in the market, which is going to be towards the fourth quarter of this year, I feel more people will put more money into these companies first, and then we are going to get chances for the other companies. When and if the market situation improves or the income improves or the inflation comes down. So if the inflation is not coming down till end of 2022, in the beginning of 2023, then what do you think is going to happen for some of these companies, some of these growth stocks? So if you look over here, all these companies are actually going to suffer a lot more if the inflation persists. And that's the worry I have, except with the exception of Walt Disney, because I think Walt Disney should be up there. Walt Disney is doing amazing in terms of reopening, in terms of their subscriber growth. So companies that I have multiple sources of income. Some companies like Disney, for example, they have their parks, they have their streaming services, they have their other services, their movie business. These companies will do well as confidence comes back in the market. But companies, those who are struggling already because they have very limited sources of income, in terms of only one source of income, for example, members, is going to get hammered for a very long time. So this is where things get interesting. With inflation running hot, and we will continue to run hot for many more months. And Russia-Ukraine might end the war, but the effect on the energy prices will be seen for many months. I truly feel we are in this rut for a very long time, and this is a warning for all investors. My opinion only, and I'm not asking anyone to do anything, but I feel we are going to be in this bear market for a very long time, especially for the growth company. And this is not good for financial stocks, especially as member growth may stale and product revenue per member may stale. More on that later. Hope you liked today's video, and if you got some value, then consider subscribing and give this video a thumbs up. And to chat with like-minded investors, consider joining our Patreon and Discord. Links are given below. And also get free Neo stock with moomoo promotion by clicking on the link in the description. I actually signed up with them just a few weeks ago, and the watch list feature that I shared with everyone today is actually pretty awesome. It's one of the best watch lists you can customize that I have seen in a very long time. So check it out and let me know in the comments, and I can do a quick tutorial in the coming days to show you how to set up the watch list and also what I look for when I first log in. As always, a pleasure to share this. Until next time, you all have a sparkling day.